Options trading, lesson number 1. What is an option? An option is just a contract or an agreement between a buyer and a seller. The seller creates the contract and then sells it to the buyer for a given premium. This contract gives the buyer the right, if he wants, to buy or sell 100 shares of the underlying stock at a predetermined price called the strike price. This has to be done within a certain period of time because every contract has an expiration date. In turn, the seller, by receiving cash, agrees to the obligation to fulfill the order if the buyer decides to exercise that contract and actually buy or sell those 100 shares. Options trading, lesson number 2. There are 3 main differences to stocks and options. The first is that options have expiration dates. A stock you can own forever, but after an options contract expires, that contract basically disappears. The second is that every options contract has a strike price. For example, if this is an Apple's contract with a strike price of $115, that means that this contract can be converted into 100 shares of Apple at a share price of $115. The third is that every options contract has a multiplier. If you see a stock with a share price of $120, you can buy that share for $120. But if this contract costs $3, you actually need $300 to buy it because every contract is 100 shares of that stock. Options trading, lesson number 3. So there are 2 types of options contracts. You have call options and you have put options. And then you have 2 ways of making money off of these options. You can either buy the option or you can sell the option. If you buy a call option, it is because you are bullish on the stock and you think a stock is going to go up. So if you buy it at this point and the stock goes up, then you profit. If you sell a call option, it is because you are bearish on a stock and you will profit if the stock price goes down or if the price stays around the same. You can see that whenever you're selling, you have a whole extra horizontal line that you don't have whenever you're buying. That is one of the reasons why you statistically have a higher probability of profiting whenever you sell option contracts as compared to whenever you buy options contracts. Options trading, lesson number 4. A lot of people are worried about the risks associated with options, so here are the options profit loss diagrams. Anything above these lines is a profit, anything below this line is a loss. Whenever you buy a call option, your max loss is the price that you paid for that call option. Your max gain is theoretically unlimited. Whenever you buy a put option, your max loss is the price that you paid for that put option, and although your gains can be very large, they are capped whenever the share price hits 0. This line means a share price of 0. Whenever you sell a call, your max gain is however much you sold that call for, and your losses are theoretically unlimited. Whenever you sell a put, your max gain is the price that you sold that put for, and your max loss, although they can be very large, are capped once the share price hits 0. Options trading, lesson number 5. Buying call options explained. Whenever you buy a call option, you are buying the right to buy 100 shares of a stock at a predetermined price called the strike price. So let's say we buy a call option for stock XYZ and we pay a premium of $150 for the contract. The strike price is $50 and the contract expires in 1 month. Let's say that at the time the contract is bought, the share price of the stock is at $50. Let's say that 1 month down the line, right before expiration, the share price is at $55. Well, I have a contract that says that I can buy it at $50. That's a $5 profit, and since every contract is 100 shares, that's a $500 profit minus the $150 premium, of course. Now, let's say that the other scenario happens. Let's say that right before expiration, the share price is $45. Well, I'm not going to buy it at $50. Instead, I'm just not going to do anything, let the contract expire, and I lose the $150. Options trading, lesson number 6. Buying a put option explained. Whenever you buy a put option, you are buying the right to sell 100 shares of a stock at a predetermined price called the strike price. So let's say we buy a put option for stock XYZ. We pay a premium of $150 for the contract. The strike price is $50 and the contract expires in 1 month. Let's say that at the time we buy the contract, the share price is $50 and 1 month down the line, right before expiration, the share price is at $45. Well, if I have a contract that says I can sell it at $50, that would mean a $5 profit times 100 because every contract is 100 shares. That would be a $500 profit minus the premium of 150, that's a $350 profit. Now let's say that the opposite scenario happens. Right before expiration, it's at $55 a share. Well, I'm not going to sell it at $50, so what do? Nothing. I let the contract expire and I lose the $150 I paid in premium. Options trading, lesson number 7. Option contract multiplier. Whenever you're buying regular shares of a stock, let's say you're buying Apple stock and it costs $120 per share, you pay that $120 and you receive that 1 share of Apple stock. But whenever you're buying option contracts, the pricing is a little trickier. That's because that every call and put option actually represents 100 shares of that stock. It's a 1 to 100 ratio. So I'm on Robinhood and I have the Apple call options pulled up with an expiration of December 18th. And if you look at that $125 call, you'll see that the price is $2.36. And what you need to realize is that this is the price per share. Since every contract is 100 shares, the premium that you're going to end up paying for this contract is actually 100 times that. And you can see this whenever you actually go to execute the order. So right here, I put in I want 1 contract, and you can see that the max cost shows $236. Options trading, lesson number 8. The price of an options contract can be made up of 2 separate factors, intrinsic and extrinsic value. You can think of intrinsic value as the value you would get if you were to exercise that option at its strike price. Let's say we have stock XYZ that has a current share price of $50 and we are looking at 2 separate call options. If we were to exercise this top call option with a strike price of $40, we would be buying 100 shares at the price of $40. Well, that's $10 less than you would be paying on the open market. So that $10 is its intrinsic value. Now, if you were to exercise the call option with a $55 strike price, you wouldn't be getting any value because in fact, you could be paying $5 less on the open market than you would by exercising this contract. So this has a $0 of intrinsic value. Options trading, lesson number 9. An option's extrinsic value is basically an option's time value. If you buy a call option that expires in 3 weeks, that means that you have 3 weeks for that stock price to go up and therefore increase the value of your call option. So let's look at a call option example where the stock price is $100 per share and the strike price for the contract is $75. Well, if the strike price is $75, that means that the intrinsic value would be $25. Because if you were to exercise this contract and buy 100 shares at $75, you would be paying $25 less than the current share price. But if the intrinsic is $25 and the price of the contract is $30, that means that that extra $5 must be extrinsic value. So you're basically paying $5 worth of time for this contract to potentially become more valuable. Options trading, lesson number 10. There are 4 important option Greeks to know. You can think of each one as a Greek god that affects your options contract in different ways. Right now, we're going to be talking about delta. Delta changes the price of your options contract per $1 move in the underlying stock. So let's say that we're looking at an Apple call option and say the price of Apple is currently $122 a share. The price of the contract is $3 and let's say the delta is 0.70. That means that if Apple moves up to $123 per share, the price of the contract would increase by a value of delta up to $3.70. This also means that if Apple were to go down $1, the price of the contract would go down by a value of delta. Also note that delta is not a fixed number and will change as the underlying stock price changes. Options trading, lesson 11. Options Greeks. So in the previous lesson, we talked about how delta affects the price of the contract. Now we're going to be talking about how gamma changes delta per $1 move in the underlying stock. So let's say that we're looking at a call option for Apple. Apple is currently at $122 per share. Let's say the price of the contract is $3. The delta is 0.70. That means that if Apple goes up to $123 per share, the price of the contract would then go up by a factor of delta, so $3.70, but the new delta is going to go up by a factor of gamma, 0.06, so 0.70 to 0.76. That means that for the next $1 increase, the price of the contract will now go up by 0.76 as compared to the 0.7. Options trading, lesson number 12. Option Greeks, now we're going to be talking about theta, which is known as time decay. Whenever you buy an option, every day that you hold on to that option, the value of that contract is going to decrease by a value of theta. So let's say that we're looking at a call option for Apple, which is currently priced at $122 per share. Let's say the price of the contract is $3, and let's say this contract has a theta of 0.07. That means that if the following day Apple stays at $122 per share, the price of the contract will still decrease by a value of theta, so going down to $2.93. Also note that theta is not a fixed number and will increase the closer you get to expiration, therefore eating away at your profits. So theta works in favor of option sellers and it works against option buyers. Options trading, lesson number 12. Option Greeks, now we're going to be talking about vega. Vega is going to change the price of the options contract per 1% change in the implied volatility. So let's say that we're looking at a call option for Apple. Apple is currently priced at $122 per share. Let's say the price of the contract is $3 and the current implied volatility is 30%, and this contract has a vega of 0.09. That means that if the implied volatility goes up by 1% up to 31%, the price of the contract will go up by 0.09, which is our vega, to $3.09. Also note that if it goes down by 1%, the price of the contract would go down by 0.09 in this instance. Options trading, lesson number 14. An options break even is the price that you need the stock to be at by expiration to neither have won nor lost money. Whenever you're looking at call options, the way to get the break even is by adding the strike price plus the price of the contract. So in this Apple example, the strike price is $128, the price of the contract is $2.40. So you add that together to get a break even of $130.40, meaning that by expiration, if the price of Apple is $130.40, you would neither have won nor lost money. Now for put options, to get the break even, you're going to subtract the price of the contract from the strike price. So in this case, the break even would be 128 minus 175 to get $126.25. Options trading, lesson number 15. Implied volatility is a very important concept for option traders to understand. In a nutshell, implied volatility just shows you how much demand there is for an option. If a particular option has a very high demand, the price of that option is also going to be high. Basically, the market is expecting large movements to happen with that stock price. So why does this matter? Well, if you buy an option that has a very high implied volatility, or at least higher than its average, you are essentially paying more for that option than you normally would. If you buy something with a high implied volatility, because implied volatility tends to revert to its mean, basically meaning it tends to go back to its average, there's a chance that even if the stock price doesn't move, your option contract will decrease in value. This is a reason why a lot of option buyers rather buy options with lower implied volatilities compared to its average. Options trading, lesson number 16. There are two parties involved whenever you are trading options. You have the option buyer, and then you have an option creator, also known as the option seller. The option creator quite literally creates an option out of thin air and then sells that option to the option buyer. In return, that person receives a premium, and that is the most amount of money the option seller can make. For receiving this premium, the option seller has agreed to a specific obligation. The obligation that the seller agrees to is going to be different depending on whether they sold a call or a put option. My next two videos are going to be explaining the obligations on both types, so make sure you follow for more.